Hello everyone. Today we are going to study CBSE Class 12 Business Studies NCERT textbook chapter number 10 Financial Market. As the name suggests, financial markets are those platforms where financial elements are traded. Now these financial elements could be stock market, bonds, forex, derivatives, etc. Let us now understand the concept of financial market. Now, these markets link the savers and the investors by mobilizing the funds between them. That means all those people who are earning or who have the capacity to earn, instead of saving, they are being provided through the financial markets a platform wherein they can watch their money grow through the process of investment. The situation that is provided by the financial market helps both the investors as well as the business firms. The ROR to the households increase, that means the money that would have been saved by those who are earning members of a family through the process of investment, now they are going to earn more money on that money. So that is basically the rate of return that the households will achieve, as well as the financial resources, which is a very important concept. What we have studied even in business finance when we were doing chapter number 9, we realized that financial resources form a very integral part for any business organization, as well as its growth is being decided by the amount of funds that it has in its hands. Now, if you look at the picture, you can see that through the households and the process of financial intermediation, the money goes either to the banks in the form of savings, or it would be going towards the financial markets as investment. Now, in both the cases, the banks will lend it to the business firms as debt or what we call as loans, or through the financial markets, the companies can raise funds through shares and debentures. This is how financial market creates and helps in the exchange of financial assets. Financial market also helps in various financial transactions, that is initial issue of shares and debentures, which is what we are going to study through the primary market, that is what it happens, as well as purchase and sale of existing financial assets like equity, shares, debentures and bonds. Now all these things are being exchanged, that means they are bought and sold through the platform of financial market. Let us now understand the various functions of the financial markets. Financial markets help in the mobilization of savings and channeling them into the most productive uses, which means that all those people who have the capacity to earn will have certain surplus funds. Now, through the financial markets, these surplus funds are converted from savings to smart investments, where the people who have the earning capacity and all those who are putting their money in the investment through the financial markets, they watch their money grow. Facilitate price discovery. All those members who have an earning capacity become the suppliers of funds, and the business firms which require finances, they have the demand for these funds. Now, what financial market does through the concept of demand and supply is it establishes the correct price for the financial asset which is being traded between these suppliers and those who are in who demand for the finances. Through the financial market, liquidity is established to various financial assets, which will facilitate easy purchase and sale of these assets. Reduce the cost of transactions. By providing valuable information about the securities which are being traded in the financial market, it helps to save time, effort and money. Now, this financial market actually becomes a common platform where the buyers and the sellers meet. Financial markets can be broadly classified into money market and capital market. Capital market is further classified into primary market, which deals with both debt and equity, as well as secondary market, which also deals with debt and equity. Money market is an organized market where participants can lend and borrow short-term securities with average maturity of 1 year or less. This market enables government, banks and other large institutions to sell short-term securities to fund their short-term cash flow needs. At the same time, it allows individual investors and large institutions to invest excess cash in a low risk market. The instruments issued through the money market are of low risk, unsecured short term debt which are highly liquid. Also, there is no physical location for this money market and all the transactions are carried through telephone or internet. Some of the major participants are RBI, commercial banks, non-banking finance companies, state government, large corporate houses and mutual funds. Now suppose there are certain large corporations which have short-term cash flow needs, then they can borrow from the market directly through their dealer and those with excess cash can invest. Similarly, the small companies which exist, they can invest their excess cash through money market mutual funds. Individuals who want to invest in the money market can do it through their bank account or money market mutual funds. Let us now look at some of the money market instruments. Treasury bill. These are short-term borrowings by Government of India which is issued by the RBI on behalf of central government. They are also known as zero coupon bonds. These are promissory notes which are highly liquid with an assured yield and negligible risk. The treasury bill is issued lesser than the face value and repaid at par, and whatever the difference remains is called the discount and also is the interest that is receivable. These are traded with a minimum amount of rupees 25,000 and multiples thereof. Under the RBI rules and regulations, the commercial banks are required to maintain certain minimum cash balance, also known as the cash reserve ratio. This minimum cash balance is changed by RBI from time to time and thus maintained by the commercial banks through the call money. Call money is short-term finance repayable on demand with a maturity period of 1 to 15 days. And these are primarily used for interbank transactions. The interest paid on call money loans is called the call rate, which is highly volatile and changes day to day or even hour to hour. This frequent rise in call money rates makes other sources of finance cheaper than call money. Commercial bill is a bill of exchange used to finance working capital requirements of business firms. These are short-term, negotiable, self-liquidating instruments which are used to finance credit sales of firms. Now, when goods are sold on credit, the seller, the person who is selling or the drawer, draws commercial bills and the buyer, who is the drawee, accepts it. And then this bill becomes a marketable instrument called the trade bill. And when the seller requires money, then he exchanges or trades this trade bill with a bank before the maturity period. And the bank will purchase this trade bill at a discounted price. When the trade bill is accepted by the commercial banks, it is known as the commercial bill. Another instrument which is issued by large credit-worthy companies are the commercial papers. These are short-term, unsecured promissory notes which are negotiable and transferable by endorsement with a delivery with fixed maturity period. Now, the companies sell these commercial papers at a discounted price with the purpose to manage short-term funds for seasonal and working capital needs. Now, in case for a particular season they require certain amount, then they issue these commercial papers which have a maturity period of 15 days to 1 year. Now, what these credit-worthy companies will do basically is they will have these commercial papers, let us say with a value of 1 lakh rupees, and then they will sell it at a discounted price and then they will redeem it at par. That means if you want to purchase this commercial paper, you will get at a discounted price which is less than 1 lakh. But when you sell it back to the company, when you are selling the commercial paper back, then it will be redeemed at par. That means you will get the value of 1 lakh which is being written on the commercial paper. So whatever the difference that lies is the interest that you earn on the commercial paper. The funds which are raised through commercial paper to meet the flotation cost for many companies, now this is known as bridge financing. When commercial banks and financial institutions face tight liquidity, then they have this unsecured negotiable short-term instruments called certificates of deposit, which are in bearer form, and they are sold to individuals, corporations and companies. The certificates of deposit are issued especially when the deposit growth of banks is slow and the demand of credit is high. So basically, when a customer agrees to purchase a certificate of deposit, he is basically agreeing to leave a lump sum deposit which is untouched for a predetermined period of time. From the customer point of view, he earns a premium interest rate on that amount which is being deposited, and from the bank point of view, they have liquidity of finances. So these are the various money market instruments which are traded in our country.